Hey everybody, welcome back to the show. So today I want to talk about rebalancing your portfolio. This issue came up because in last Sunday's newsletter, it's a newsletter I send out every Sunday morning, I included a link to this report on rebalancing and what's the optimal approach. And I got a lot of reader emails saying, hey, can you walk through this report? And so here's what we're going to do. I'm going to walk through this report. It's from Nick is a blogger at Of Dollars and Data. I link to his content frequently. He was behind this report along with Y charts, and they look at 4 different approaches to rebalancing. We'll talk about it. So what we're going to do, I'll walk through the findings of this report. I'm going to show you a free tool you can use to analyze different rebalancing approaches for your own portfolio. We'll even look at what Nick did through this tool. I'll talk about an alternative approach that he didn't cover that you might want to consider. And then I'll just, at the end, share my approach to rebalancing, for what it's worth. So here's the report. And again, he looked at 4 different approaches: rebalancing once a quarter, once a year, 10% drift, we'll talk about that, and then never rebalancing. Those were the 4 approaches. The 10% drift, this is important to understand. When you talk about drift, when you have an asset allocation plan, and when it varies, markets go up and down, your stocks go up or down, bonds change, and you can drift away from your plan. And so what the idea of a 10% drift is, when we drift by more than 10% from our plan, that would trigger the rebalancing. So in theory, it could happen, I guess, multiple times a year, or maybe not at all for several years, right? It just depends on what the market is doing. Now, the one thing about this report that was unclear to me, when he says 10% drift, we can look at his portfolio. This was the portfolio he used. These are just Vanguard index funds. And let's use the first one as an example. 35% in total U.S. market. So what does 10% drift mean? Well, it can mean you do plus or minus 10%. So you'd have this sort of rebalancing band, I'll call it, of, I guess, 25% on the low end and 45% on the high end. And so you wouldn't rebalance this particular fund until that 35% went above 45 or below 25. That's called an absolute band or an absolute drift. But there's also something called a relative drift. And what you do there is you wouldn't just add 10% to each of these percentages and subtract 10% as well to get your rebalancing band. What you would do instead is it would be relative to each of these classes. So you'd take 10% of 35, which is 3.5%, and that's what you would add and subtract. So that would trigger rebalancing, let's say, on the high end at 38.5%. That's a big difference between that and 45%. And for me, it raised the question, was this 10% drift relative or absolute? And the paper, I couldn't find the answer in the paper. I did see that he did a video along with Y charts where he walked through the paper. I'll link to that as well, by the way, below the video. And from what I could tell, he used an absolute 10%. So in other words, this 35% would have to either fall below 25 or above 45 before it would trigger rebalancing. This 10%, it would really, I guess, never rebalance on the low end. I don't think it's going to go below 0%, but I guess in theory could go above 20%. So I think he's using absolute drift here, and that's important, as you'll see, because I'm going to show you an alternative approach in a little bit that uses relative drift instead of absolute. But that's what he did here, and we can summarize the findings. Again, I'll link to this below the video, but basically what he concluded was the following: that if we look at the total 29-year period he examined, and you want to say, what's the best outcome at the end of that 29 years? It's no rebalancing at all. If you don't rebalance at all, you have the highest portfolio at the end of 29 years. I think the worst case was quarterly. That ended up being the worst case, and the difference was about 1.95%, pretty significant. So that's sort of finding one. But the other thing he found was that the never rebalance approach, while it won out when you looked at that 29-year period, if you looked at shorter periods, sometimes it didn't win out. And what he found was that in bull markets, never rebalance approach actually worked well. And that kind of makes sense because stocks are going up and up and up, and you're not selling them to buy bonds, right? You're just letting them run. But in bear markets, when the market crashes, actually the never rebalance approach was the worst of the 4. It may have won out over the whole 29-year period, But when we enter a bear market, doesn't do so well. Now, one thing that surprised me in his findings is this right here. What he looked at a number of different ways to analyze each of these approaches, but the one I focused on is this max drawdown. What he found in bear markets was that the annual rebalancing approach was the best in terms of preserving capital. Okay, fair enough. But what surprised me was it doesn't preserve it all that much. I mean, the Never Rebalance lost, what, 38%? That was its max drawdown. Well, I guess I'd prefer to lose 36% rather than 38%, but I mean, it does, honestly, as someone in and near retirement, it doesn't give me a whole lot of comfort. So yeah, the annual rebalancing preserved the capital best in really bad markets, but you still lost a lot of money. And keep in mind, he was using a 60-40 portfolio. My big takeaway at the end of the day was that all of these sort of operated within general parameters. There wasn't some big outlier, in my view, that showed one to be very different than the other. The Never Rebalance, again, had the best performance over 29 years, and so someone could choose to not rebalance for that reason. By the way, I don't necessarily think that's an unreasonable approach, but I do think if it's an approach you're going to take, one question you might ask yourself is, if I'm willing to accept the higher risks associated with never rebalancing because my portfolio is going to drift towards stocks over time, why don't I just start with a higher allocation to equities to begin with? It's a question. Now, having said all of that, one question might be, well, how can we visualize this drift if we're going to consider never rebalancing versus one of these other approaches? And that brings me to this free tool I want to show you. And we'll look at that first, then I'll go to this alternative approach that I alluded to. So the free tool is one we've used many times. Here it is, Portfolio Visualizer. And what I've done, I'm using the backtest asset class allocation tool because it gives us more data. You can see we get basically roughly the same time period that Nick looked at, roughly 30 years. And I've put in the portfolio he used. I'm using asset classes rather than specific Vanguard index funds, but we'll get very similar results. And here's the thing that you might not know about Portfolio Visualizer is that you can test different rebalancing strategies. So if we edit the portfolio, and let me get rid of this. I was testing some other things before I started the show. If we go to settings, you can see right here, rebalancing. And we have it set for annual. We're going to look at some others in a second. So if we analyze this portfolio, $1 million turns into $8 million after 30 years. It's not bad. So keep that in mind. Now, we'll switch to never rebalancing. No rebalancing at all. And the 8 million jumps to 9.5 million. Big difference. Of course, we're talking about $1 million to start with, and it's a 30-year period. But we are taking on more risk, and this is another part of the tool that I really like. And we can go to allocation drift here. It's just at the bottom of the page. We can just scroll down, or we can click this link here. It takes us to the bottom. And you get to see in this nice graph how it's drifting. So if we start to the far left, remember our U.S. stock market, which is the bottom blue colored area, started at 35% in 1995. Remember, we're not going to rebalance. So when we get to 2025, we're at 75%. I mean, it's a huge jump. And it makes sense because the U.S. stock market, particularly the last 15 years or so, has been on a tear. And so you get to see that we have a much different allocation. In fact, we were at 60-40 stocks to bonds. Now I'm looking at the bonds now are only 14%. So yes, we do have a really big difference in performance. That's good. But we've really pretty significantly changed the risk associated with the portfolio. Of course, you'll have to assess what makes sense for you. By the way, I'll just point out in this table, you get a year-by-year allocation that you can look at and see how it changes year to year, which I think can be useful. And then from here, what we can do is try other things. Now, I mentioned other rebalancing approaches. We can do semi-annual, quarterly, or monthly, but what I want to focus on is the rebalance bands. And that's where we see this absolute and relative that I talked about. So I think what he was doing was effectively a 10% absolute, and then I'll put relative at 100%, which I think should basically cause it to never trigger, because none of these asset classes should deviate by 100%. And if we analyze that, yeah, we're right around 8 million. It's not much different than annual rebalancing, which I think is, for the most part, consistent with what he found. But we can then test other things. So we can go back to the 5%. This is the default settings, and 25%. So again, this 5% would just be added and subtracted from each asset class's allocation. So if an allocation is 35%, it would just, you'd add and subtract 5% to that to determine when you would trigger rebalancing. And the relative would be you take 25% of each of those allocations. So Portfolio Visualizer can do both. And so depending on the asset class, either one of these could trigger rebalancing. You'll notice we get to 8.3, almost 8.4 million. It's not as good as never rebalancing, but it is better than annual rebalancing, and I'm pretty confident it would be better than semi-annual or quarterly or monthly as well, but you can test those on your own. And that brings me to another paper that I want to show you. Here it is. It's called Opportunistic Rebalancing. This was a paper published back in 2008, and there's a lot of detail here. I'll link to the paper below the video, but what it did basically was this. It used relative rebalancing, so it didn't take 10%, just add and subtract to each asset class. It actually took 10% of each asset class's allocation and used that as its band. Hope you're following that. So it took, and it found that if you use a 20% relative band and you look at your portfolio frequently to see if it needs rebalancing. Of course, most of the time with a 20% relative rebalancing band, it's not going to need rebalancing, but the paper looked at different time periods in which you could at least check. Now you may say, well, wait a minute, Rob, shouldn't I just check daily? Well, that's up to you. The paper actually did evaluate checking daily, but it also looked at checking a number of different time periods, including every 250 trading days, which is effectively about a year. And what the paper found was that 20% relative rebalancing band, it looked at others, but that was generally got to the best results. And looking at your portfolio to see if it needed rebalancing pretty frequently, even daily, was actually the best approach. Again, it wouldn't trigger rebalancing daily. You might go more than a year without rebalancing, but you're at least looking at your portfolio frequently to assess whether you should rebalance. And so that's what the paper found was the best alternative. I mentioned that to you. It honestly, I don't think it's as complicated as as I'm probably making it sound. You can read the paper for yourself. I actually talked about a free spreadsheet in a prior video earlier this week that you can actually use to trigger these bands and get an alert when you need to rebalance based on, for example, a 20% relative band. I'll leave a link to the article that has that spreadsheet in it so you can check it out if that's useful to you. So that's my take on Nick's paper. I think Nick's paper is interesting. I didn't find the results surprising, but I would caution you that while he looked at 4 different approaches, those aren't the only approaches. And I think looking at relative bands for rebalancing rather than absolute kind of, I think, is an area of opportunity, particularly if you have a more complex portfolio with a lot of different sub-asset classes, like think REITs, emerging markets, small cap value, maybe a commodities fund. I think that kind of approach that is described again in this paper that I'll link to below the video is certainly worth considering. So having said all of that, what do? Not that my approach is the best approach, but it works for me. So a couple of things. I've recently moved most of our retirement money into a Vanguard target date retirement fund. So I don't do anything. Vanguard rebalances for me. We do have a couple of stocks, but primarily 3 index funds in our taxable accounts, a total U.S. Index fund, a total international index fund, and a small cap index fund. And my general rule is to not rebalance by going in and buying and selling because I don't want to trigger taxes. I can If I've drifted from my allocation, which I do from time to time, I can affect that based on either new contributions that I'm making, putting them in the fund that needs a little bit of boost because it's fallen below its target, or if I'm pulling money out, taking it from the fund that's maybe done well and is above its targeted asset allocation. So I'm using those sorts of approaches to keep my portfolio at least close to our plan. I will say I pay most attention to the overall stock bond allocation. For us, that's 75% stocks, and I use an absolute band for that of 5%. So if it were to go above 80% or below 70%, I would take action and rebalance it. Although in my case, I would figure out a way to do it inside the retirement account. I suppose in theory, that could mean selling part of the Vanguard Target Date Retirement Fund to purchase whatever asset class I needed to, probably bonds in most of the time, to bring my allocation back in line with that 75-25 target allocation. But again, I've got a 5% absolute band on either side. And so the truth is, I can go a very long time without actually having to go in and buy and sell in order to rebalance. And for us and for me, it's important because I think it's not just a function of theoretically what's the best approach, which, by the way, can change from one time period to another. It can change based on your specific asset allocation versus mine, all perhaps important. But for me, a big factor is just simplicity. And I think if I can reduce the amount of time I need to spend thinking about and actually rebalancing a portfolio, I think that would be best. Now, that being said, if I had a more complicated portfolio with a lot of sub-asset classes, frankly, I would be focusing on this paper and this approach of the opportunistic rebalancing over the approaches that Nick evaluated in his paper. So there you go. That's my take on rebalancing in general and Nick's paper, which I thought is a great read, and I encourage you to read it if you haven't. Again, I'll link to everything below the video. And Portfolio Visualizer, a great free tool. And I should mention, as you're testing different rebalancing approaches, and in fact, this is so important, let me just quickly show it to you. I'm sorry. But in addition to setting the rebalance approach, you can also model either contributing money if you're still saving for retirement, or if you're in retirement and you're withdrawing funds, you can model withdrawing those funds. You can put in a certain amount, you can have it adjusted for inflation or not, how frequently the withdrawals are going to happen. I think that's an important part of any tests that you want to run to evaluate your own strategy. You want to have cash flows, assuming you're either adding to your portfolios or if you're in retirement and you're drawing from them, you want to model that as part of testing the different approaches to rebalancing. Well, there you go. If you have any questions, leave them in the comments below. I'll be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.